Welcome back to Corporate Finance, guys. So today we are going to talk about net present value. What is net present value? Future streams of cash flows discounted to the present day to decide how much to pay today for that stream of cash flows. So, sounds a bit complex. So let's take an example with Bob. So, Bob wants to buy a building and he wants to sell that building in 1 year and make some money off of it. But he doesn't know if he was going to make some money out of it, so he has to figure that out. So the cost of that building today is 370,000. And if you sell that building in a year, the building costs 420,000. So simple addition or subtraction will not give you how much money he's going to make off that building. And that's where net present value comes into place. So now Bob has to calculate the net present value at an interest rate of 5%. So what is the NPV? NPV equal to present value. So first we have to calculate the present value. Through the discounting formula, we know what is present value. Present value formula is equal to the cash flow divided by 1 plus I. Raised to present value equal to cash flow divided by 1 plus I. Therefore, we have 420,000 at an interest rate of 5%. Therefore, 1 plus 0.05, which is equal to 400,000. Now, the present value is 400,000. And we have the initial investment, which is equal to 370,000. So what is NPV? It's 400,000 minus 370,000, which is equal to 30,000, which is good because it's a positive number. That's the first point. Second point, he makes 30,000 more if he sells the building in 1 year. Now, let's say when you calculate this and you get a negative amount. If you get a negative amount, that is not a good investment because you lose money if you sell the building in 1 year. But now, since he gets 30,000 more in 1 year, it is a positive investment. So coming back to this, net present value is basically you have your future cash flow and you have the initial investment that you're supposed to make. And using discounting, you calculate the net present value minus the initial investment. And therefore, gives you the net present value, which is positive. That means it's a good investment. If it is negative, well, that's a bad investment. So keep Bob in mind. So guys, I hope you understood NPV and Bob's example. So now we're moving on to two different options. So in the first case, Bob bought the building and it is more outside the city. So now he has another option. He still has a decision to make whether to buy it or not, let's say. And the deal is that now he can buy another building in the city center, but at a higher interest rate, at an interest rate of 12%. When we increase the interest rate, what happens? So as you can see in this slide, higher risk projects require a higher rate of return. So that means the riskier the project, the more return you expect to get out of it. Higher required rates of returns cause lower present values. So higher required rate of returns can end up with lower present values. I hope that's understandable, but let's dive deeper. So present value with 420,000 at 5%, which we calculated earlier, gives us 400,000. We already saw that. Now we look into the example of the city center. It's at 12%, 420,000 divided by 1.12. Why? Because of 12%. Gives him only 375,000 of present value. So it's lower. Therefore, the NPV at 5% is 30,000, as you can see. And NPV at 12% is 5,000. So it's clear that Bob chooses the example of getting the building a little bit outside the city because it's more riskier, it costs more interest rate, and therefore he chooses the first over the second. So the more riskier cash flow, the lower is its present value. The more riskier project, the lower is its net present value. So I hope this is clear to you guys. And let's move on to the two rules that you have to keep in mind when you calculate net present value and rate of return. So, guys, the two most important rules that we need to keep in mind. Whenever you calculate the net present value, the NPV, it always, all investments is a good investment if it is a positive value. If it's a negative value, it is a bad investment. So keep in mind, it's a good investment if it is a positive value. Now, rate of return rule, accept investments, rate of return rule, accept investments that offer rates of return in excess of their capital. So these are the two rules, and keep it in mind when you make your calculations and when you have your answers, because in the exams it's going to be completely different because you're going to have real life examples, not just plug in the formulas. So, guys, we are completed, and I will see you on Wednesday and some of you on Thursday. So, until then, I hope you've watched this video and have an idea on NPV. We will dive deeper and do a lot of calculations on Wednesday and Thursday. So, until then, have a great week, take care of yourself, and see you soon.